Imagine this scenario. You walk out to your driveway and you see this brand new luxury car sitting there. It's yours. You own it, but you can't find the keys. So you're stuck taking the bus to work while your $100,000 car sits in the driveway collecting dust. That is exactly what is happening to millions of homeowners right now in December 2025. You're sitting on a gold mine, and it's called home equity. Maybe 100,000, maybe 300,000, but you feel stuck. You can't access it because you're terrified of losing that beautiful 2%, 3%, 4% interest rate that you locked in years ago. So you stay house rich, but cash poor. Are you struggling with credit card bills? Are you delaying renovations? Are you stressed about tuition? All while you're sitting on a pile of cash. Well, welcome to day 3 of the 12 Days of Housing Challenge. I'm Cathy Sabater, and today I'm going to hand you the keys to that car. I'm going to show you exactly how to unlock your home's value, guess what, without touching your first mortgage. We're going to cover the blended rates secret, the tax implication nobody talks about. And I'll walk you through a real life case study that saved a family about $700 a month. But first, let's look at the reality of the market right now. Despite all the headlines, home values have held strong. If you bought before 2022, your home is likely worth more 20%, 30%, maybe even 40% more than what you paid for it. But here's the problem. Life has gotten expensive. Inflation has driven up the cost of groceries, insurance, repairs. And if you have credit card debts, you know the pain. Interest rates on credit cards are hovering around what? 22, 25%. That is financial quicksand. Every month you pay the minimum, but you sink a little deeper in debt. The old school advice was simple, just refinance. But trading a 3% mortgage for a 6.25, 6.5% mortgage today doesn't make sense. It's like stepping over a dollar to pick up a dime. Do not do that unless you have no other choice. Instead, we use what's called junior liens, loans that sit behind your first mortgage. They let you keep what? Your low rate on the big loan while borrowing what you need. You have 3 main tools to access this equity. Choosing the wrong one is the most common mistake that I see. Let's break them down so you know exactly which one fits your life. The first one, the HELOC, Home Equity Line of Credit. Think of this like a giant credit card attached to your house. It's a revolving line of credit. It's best for people who need flexibility. Maybe you're doing a renovation in stages. You pay the contractor $10,000 now, $10,000 in 2 months. You only pay interest on what you borrow. The trap? What's the trap? The rate is variable, which means it changes. It's tied to the prime rate. And if the Fed decides to hike rates next year, your HELOC payment goes up instantly. It can be unpredictable. Second is the home equity loan. This is a fixed second. This is my favorite tool for 2025, especially for debt consolidation. It's a second mortgage with a fixed interest rate and a fixed term, 10, 15, or 20 years. Best for paying off credit cards or one big expense like a wedding or a roof. Why I like it? It's safe. You know exactly what your payment's going to be for the next 5, 10, 15, 20 years. It never changes, no matter what the Feds does. Okay? You get the money in one lump sum, you pay off your debt, and then you're done. What's the third one? Well, the third one is the cash out refinance. This is the nuclear option. This replaces your entire mortgage, Your 3% loan goes bye bye. But when to use it? Honestly, only if you have massive amount of high interest debt that a second mortgage cannot cover. Or if your current rate is already high, like 6% or higher, and refinancing doesn't hurt you much. Okay? Now, stay with me. This is the aha moment. This is the math banks don't usually explain to you. It's called a blended rate. Clients tell me, Cathy, why would I take a home equity line at 9%? That sounds expensive. And in a vacuum, it does, because it's definitely higher than the 2-3% that you have. But you don't live in a vacuum. You have to look at the total cost of borrowing. Well, let's slow this down. You ready to do a little bit of math? I know people don't like doing math, but let's do a little bit of math, okay? Imagine a $300,000 mortgage at 3%, and then you have a $30,000 credit card at 22%. You have a car loan of $20,000 at 10%, 5%. Right now, you are paying interest on three buckets. The credit card is on fire, it's burning your money. The car loan is expensive and the mortgage is cheap. So if we take out a 50,000 home equity line loan at 9% and wipe out the cards and the car, yes, that's specific. 50K is at 9%, but your massive 300,000 mortgage is still at 3%. Now, if you mathematically blend the interest cost, that huge cheap loan with the smaller new loan, your effective interest rate across the entire debt load is usually around 4 to 5%, depending on where you're at with your current mortgage. Well, think about it. You just effectively lower the interest rate on your bad debt, extra debt, from 22% down to an effective blend of maybe 4, 5, 6%. You aren't taking on more debt. You're just moving it from a toxic bucket to a cheaper, safer bucket. There is another layer to this. Taxes. Disclaimer, disclaimer. I am not a CPA, so please consult your tax professional. Interest on credit cards is never tax deductible. That money is gone forever. Interest on car loans, not deductible. However, interest on home equity loans can be tax deductible if the money is used to buy, build, or substantially improve your home. So if you use this loan to put on a new roof or remodel the kitchen, Uncle Sam might say, actually help you pay for that, even if you use it for debt consolidation. Simply moving the debt to a lower rate saves you cash flow. But the renovation play has the extra tax benefits. And what are those? Well, I have to be a responsible broker. Using your home like an ATM is dangerous if you don't have discipline. I have seen people pay off credit cards using their home equity, and then 6 months later, the credit cards are maxed out again. If you do that, you are now in double trouble. You now have a second mortgage and new credit card debt. That is how people can potentially lose their home. So, what is the golden rule? Well, this is a strategy for solving problems, not creating new ones. When we pay off these cars, I want you to cut them up or lock them away and treat this as a fresh start. And I know some of you people, it's online, you have it in the wallet. You got to say, if I can't pay it off in 3 to 6 months, can't use it. So we also follow an 80% rule. I generally recommend keeping your total loan under 80% of your home value. So if your home is worth $400,000, you shouldn't owe more than $400,000 total. This gives you a safe cushion, okay, of 20% equity just in case the market dips or you need to sell quickly. Okay? Let me bring this home with a real example from this week. The Miller family. They were paying about $1,200 a month just in minimum payments on 5 different credit cards and a personal loan. They felt like they were drowning. even though they had $200,000 in equity. We set them up with a what? Fixed rate second mortgage. Their new payment, guess what it is? It was approximately $450 a month. It wiped out the $1,200 a month obligation completely. So the math, $1,200 old payment minus 450 new payments, drum roll please, equals $750 saved every single month. That is $9,000 a year back in your pocket. Now, guess what? They kept their 3% first mortgage. So here is your 3-day challenge. Stop guessing. I want you to find out exactly how much equity you have so you can check Zillow for rough reading, but yet you can message me for a professional report. And if you want me to run the math on the blended rate scenario I talked about, comment the word equity below. And I'll also provide you a free calculator that you can plug in yourself and figure out what you want to do, right? Specific, like you have debts like your visa, your car, your student loans, and it will show you exactly how much a home equity loan could save you. I'll send it to you for free. Don't let your equity just sit there collecting dust while you, right? Because that's the only way you should be doing this if you're paying 20% interest to a bank on other debt, right? So let's make your money, right, work for you. See you tomorrow for day 4. And imagine this scenario. You walk out to your driveway and you see your brand new luxury car sitting there. You own it. It's yours, but you can't find the keys. So what do? You call Cathy, and we're going to talk about you getting a home equity loan, a HELOC, or whatever works best for you to help you keep more money in your pocket.